As you can see, we sold out 13 offerings. Now, private revenue was 6.8 million. Okay, keep in mind that last year we had 0. So it shows you the power of expanding into other categories. So as you know, we're well known for crowdfunding, which is, I would call it the series seed, early stage companies. And we've done close to 1,000 companies like that. But now we're also going to start being known for securing very interesting companies that are on the other side of the I would call it the funnel, towards the end of the funnel, where they're about to go public or get sold or keep growing. Those companies are very interesting to our investors. And it's only for accredited investors, and that's how the rules work. And we have quite a large community of those. So as you can see, in the first quarter, we did 2.1 million. The second quarter, 6.8 million. So it's pretty amazing. And also we raised $2.5 million from Reg CF offerings. So let's look at the financials in a little bit more detail. So as I mentioned, the total revenue increase, we are diversifying our revenue streams, and we have several of them. So private 6.8 million. The Venture Club, as you may know, we rebranded what we call what used to be called Owner's Bonus, but now it's called the Venture Club, and that increased as well quite significantly. So we did 1.3 million Q1 2024 versus 900,000 Q2 the previous year. Actually, I should say Q2 here. It's great. And then we have other diversification that we're planning as well. So the way we see things is that we've built a great community of investors, and to the extent that we can find investment opportunities for them that they're attracted to, this is great. All right, GAAP net loss. So GAAP general accounting principles. So we had a 3 million net loss in the second quarter, but keep in mind that 2.6 million is stock-based, so it's not a cash loss at all. It's stock. Why? Because as we issue stock options to our team, and we have close to 100 people now, those people will receive a benefit, income in stock, and then we also have to expense it. So keep in mind that it's not cash. And then we had to amortize our seed invest purchase, which was an all stock purchase. So this is also a stock expense. And we basically amortized 850,000, and we're going to have to keep doing that. Our purchase price was 24 million, by the way. So every quarter we're going to be amortizing it. So if you exclude these non-cash items, we had a small profit of $500,000. And keep in mind that our goal now is not to be to focus on profitability. We want to focus on growth. And as you can see this year, in the first two quarters, we've grown pretty nicely. And so that's our goal. And why? Because we think that once we have a significant amount of revenue, the value of the company will be better. And then we can start extracting what we'll call profits. We can start extracting them by efficiencies. But you need growth. You need some market share. You need to show that you have a diversified product line, that we have a brand that is attractive. This takes capital to do that. In terms of our balance sheet, we have cash equivalents about a little bit over 10 million. We're holding about 4+ million in private stocks that we've purchased. So in terms of our cash, as you can see, we're well capitalized. All right, so this is great. I think we've covered the basics of our second quarter. I'm now going to have questions. One of the questions just came out immediately is when is the next round open and what price? So as we mentioned, we will have down the road another offering. We said we would do that. And we probably will launch a test of waters initially. We can always do a test of waters, and we've done that in the past successfully. So we'll probably launch a test of waters sometimes in the next week or so. Watch out for that. In the test of waters, we probably won't be very precise about, what's the price, how we're going to price it. Test of waters is really indications of interest. We're not soliciting any, we're not taking any money. It's a solicitation, but it's really more interest, right? So that's going to be announced. You will receive an email. I hope you will take a look at it. We'll have a page that we put together based on a lot of the information we discussed here. The next question I see is, when will the split show in our dashboard? So we've made a split. So just to explain to everybody what this question means is, we did a 1-20 forward split. So if you had 1 share of StartEngine, you ended up with 20 shares of StartEngine. That split has been consumed. It's there. Everyone who are shareholders on the StartEngine cap table have 20 times more shares. This is just a number thing. That doesn't mean your value has increased. Not at all, of your investment. What it means is that you have 20 times more shares. That made a lot of sense to us to increase the number of shares. The last offering was at $25 a share. So if you divide by 20, it's $1.25. So just keep that in mind. Now, when will it be in your dashboard? We've deployed a lot of those in the dashboards, but some people have not been updated. We will update it. We will make sure it's updated. If you don't see it, you can always send us an email at contact. All right, next question. Due to the success of the Hard Marks AI Fund, what do you say about launching funds going forward? Seems like private is very scalable, but many of the offers are 250 to 500,000, which seems small relative to the potential here. I agree with that comment. We plan to launch another fund sometime in September. I can't give you any details of that, but that's our intention. And we start usually around 250 to 500,000, but then if the offering does well, then what we do is we increase it up to $1.5 million, $2 million. Now, why those numbers? It's very simple to explain. The way we do private is we use a regulation called Reg D 506C, and the limit is 100 investors per fund, but you can't just photocopy a fund to another fund, just photocopy it into 10 funds and then say, well, I only have 100 investors in this fund. Let me start a new one with 100 investors. That's not the intention the SEC has promulgated with the rule. The intention was that if you want a fund with over 100 investors, you need to register. Registering a fund is basically like taking the fund public. It's not exactly that, but it's basically filing with the SEC that this is a fund that's going to be supervised by them. It's quite expensive to do. It's hundreds of thousands of dollars of legal fees, plus time, plus also you have to do filings. There is a lot of consideration. So Reg D 506C is the ideal vehicle for where we are today. Ideal because we can pick 10, 20, 30, 40 stocks that are all exciting and, raise 30, 40, 50, 60 million dollars, over time for those offerings. So it's still, where we are in our life cycle is still a great opportunity. If we wanted to raise $300 million for a fund, we would go in a different direction. We would actually register the fund. I don't think we're ready for that. I think we're not ready for that at all. What we're ready for is to continue creating these Reg D 100 investor maximum funds and offering to our customers, our investors. I think this is a great opportunity. As I mentioned, we have other diversifications for our revenue that we're planning on right now as well. So it's, hopefully you will see our strategy as we develop it, that it's important to have a diversification. Our investors, if you think about it, are interested in diversifying their capital. So, for example, they could invest in the stock market. They can buy mutual funds. They can buy ETFs. Yes, that is true. They can do that. They can buy bonds. They can also buy individual stocks on the stock market, and they have full liquidity for almost everything they purchase. However, what they're missing is the private equity side of the world. And there are a lot of articles out there in the Wall Street Journal that explain how sophisticated investors, and especially wealthy investors, family offices, put a lot of emphasis in the private equity market. And there's a reason. There is a reason for that. And the reason is because you get earlier in the life cycle of an investment. Instead of coming in when a company goes public, you are there much earlier. Now, I would say that our crowdfunding business is the earliest you can be, because we have plenty of companies who are just starting and raising money on our platform. And then they come back and raise more, and eventually they mature. And it takes time. So for an investor, it's good to have a little bit of everything. You have a little bit of the very early stage, you have a little bit of the super late stage. And then we think that if we could fill some of that funnel with mid-stage investments, that would be interesting too. We also think if we could offer alternative investments such as collectibles like we've done in the past, and also real estate would be very interesting as well. All of that is, a lot of conversations we have here at StartEngine. Again, we haven't announced anything in that area, but as we do, we will make the announcements and we'll let you know. Let me take the next question. What are your thoughts on StartEngine Marketplace and that is currently going on and shaping up? What's the long-term vision? So StartEngine Marketplace is where investors can come and trade. They can sell from investor to investor their stocks that they've purchased on StartEngine, or even purchased elsewhere, because we will also list companies that had crowdfunding runs elsewhere. But by and large, it's for companies that raise money under Regulation Crowdfunding or Regulation A. However, that said, the marketplace is divided into two sections. We have a bulletin board for those stocks that don't trade often or haven't traded once, because we don't know if there's a marketplace for it. So we allow people to place offers, and to the extent someone's interested, they can just buy it. There's no bid ask, there's no negotiation. Now then you have the marketplace, what we call the rapid one. It's almost instantaneously. You place an ask and someone places a bid, and if it's matched, then it trades. It's incredible technology. Our biggest, I would say, holdback is that the way the rules are with the SEC, the stocks have what we call blue sky rules, which means that every state, and there are 50 of them, have purview and rules around it. So the only way for us to avoid registering all these stocks in every state and dealing with the blue sky was to use an exemption called the non-solicitation. So we can't market anything. We cannot talk about it. We can talk about marketplace, but we can't talk about individual stocks. We can't do any of that. And that limits the potential. Now that rule may be fixed. The Congress voted in a fix, but the Senate hasn't done their vote. We don't know when. As you know, we're going into an election cycle. So that means it's not going to be until next year. Now, hopefully it will be done next year. And then I can announce to you guys, hey, there's a new rule. Here's how it's going to work. But we need some help from the regulators to fix this. Marketplace has a tremendous amount of potential because, as you can imagine, going and buying stocks early stage, you have to be willing to wait. To the extent that we can give you an ability to sell, great, but not many people know about it from our community. So we have sellers, we have buyers, but not many of them. It's just unfortunate. We would have loved to see more activity there. So that's basically where we are with the marketplace. But I think, we'll make small progress. We haven't put a lot of focus and effort. We've put a lot of focus and effort on private, as you can see the results. Maybe next year we're going to put a lot more focus, especially if the rules get updated on the marketplace. Let me get another question. I see on the financials that StartEngine continues to burn cash. When will the cash burn stop? When will the company start having positive cash flow? Okay, it's a great question. Keep in mind, you're not looking necessarily at the cash that we've used to buy private stocks that we later resell, which is basically like having inventory. So we've had the first 2 quarters, I would call it a low burn, but we do still use our cash to buy stocks, and we'll continue to buy stocks with our cash. So in terms of getting to a pure, true cash flow, that is not the plan this year. As you can tell on a non-cash, if you take out, stock options, amortization, we made a little bit of money, which is not bad. But on the other hand, again, going back to my first comment, it's not this year. This year we want to grow, and you can see we're doing that, and we want to continue to grow. So it's not this year. Maybe next year. I don't know. We'll have to see. Once we sit down in October and we plan next year, then we will see where our priorities are. Our investors are interested in us growing, but also are interested in making sure that we become a profit-making company. And I agree with that. I think we need both. We need to grow and make money. But it's hard to do both when you're very early stage, right? So at this point on time, we're going to grow this year, and it's possible that we'll burn some cash. But as you can see, if you look at the stocks we've purchased and count that as part of, our assets, we're not depleting assets. So that's the good news. But we are making a big investment. I'll tell you, an investment we made is we hired 15 new salespeople. Those salespeople are starting to provide and show real performance. So, why did we do that? Well, it's for growth. Now, if I didn't hire those 15 salespeople, we wouldn't grow the crowdfunding, but we would start maybe making some money. But I'd rather have the salespeople, because then I can get more companies on our platform, and that will bring more investors on our platform, and they'll bring more revenue to our platform. Do you have a timeline for the IPO? I know we get that question every single time. I love that question. Now, I think you've seen this IPO market being not very favorable these days. So to make a prediction when you go public is hard, because first thing you want is a good marketplace. Imagine companies who go public now, which is sometimes too early, don't do well. They get shorted by a lot of the hedge funds, and that puts a tremendous amount of pressure on the price of the stock, and it goes down. So first there's a pop, then it goes down, and guess what happened? All of you shareholders get upset. Why get upset? We don't need that, right? We need people to be really happy with our company. So my idea is we get to a point where I'll give you a marker that I believe. For example, we have, I don't know, somewhere around 100 to 150 million revenue, growing 30% with about a 30% pre-tax profit. So let's say I'll give you an example. Let's say we're at 100 million and we have a $30 million pre-tax profit, and we are projecting the next year to do about 130 million, for example, okay? That kind of performance warrants thinking about going public. I hope you agree with me on that. And so, look at our growth rate, our look, we'll have more diversification, probably hopefully next year in our revenue base, and start showing to you that the company can get to these kinds of numbers. I think that's the best answer for you. Next question. StartEngine seems like it's the best platform up there, and it's been a lot, and it's been a lot to get profitable. Are other platforms struggling? Do you know what's going on out of the business, or ripe for a buyout? Okay, I think I understand the question. So I don't know exactly the figures. I know WeFunder has published their financials, and they recently said they made a profit in the, I think, first quarter, maybe I'm wrong, or second quarter. I think maybe second quarter. Great news. Their revenue is still small, but I think they've made their company more efficient. So they went in the route that I was just discussing, which is maybe you won't grow that much, but then you can become profitable, right? So what you do is you cut out as much cost as you can do. And they've had, I think they announced they had 2 rounds of layoffs. We have not had any rounds of layoff, just so you know, but they've had 2. So they've cut. So I guess I could play the same game. Hey, let me cut 30, 40 people out of our payroll, right? And I can tell you, we make money. I mean, you could do the math yourself. Just look at our financials, look at our operating expenses, say, hey, Card, if you cut 30% of that out, then you make money. I agree. So the question is this the right direction? Republic, I can't tell what they're doing because I don't have financials. I see that they don't raise a lot on crowdfunding, so they have other revenue sources they're focusing on outside of just Reg CF. They do very little Reg A. Then we have a Dealmaker. They're not exactly a platform. They're more of a broker-dealer service company for companies who want to really do the not go on a platform like WeFunder, like ourselves, or Republic. And there's Dalmore as well, a great company, Dalmore. They provide really the nut and bolts to companies who want to raise capital, funds who want to manage their raises and their plumbing. It's really a great company. So all of that put together, that's the marketplace. In terms of ripe for a buyout or roll up where everybody's going to go buy everybody, I don't know. We certainly bought a company last year. We hope to buy a company this year and maybe next year as well. And, yeah, there will be some consolidation. There has to be, right? There has to be consolidation. I think that's the name of the game. And then as we consolidate, and let's say StartEngine starts consolidating, we become bigger and a little bit more market share. Keep in mind that the regulators are not looking for one player in one market. They won't accept that. So we need multiple players. And I think what we have now is healthy. We have a question. How do you get to the 38% profit margin on private? So private, we purchase the shares ourselves. We take the risk. We are a principal and an investor in the trade. So we don't trade. We buy the stock. We hold it for a certain period of time. We have to do all the work to get the transfer to us, to StartEngine. Once that's completed and we've held it for a certain period of time, then we offer it to our investors. Now, in the meantime, the prices can change because, hey, pricing can go up, price can go down. There is a market for those stocks. And it's not a small market. It's billions of dollars market. So once we sell it to our investors, we're able to have our, I would say, our commission available. So this is actually very good. And so that commission is maybe what you're talking about. It's not a commission. It's basically a a profit margin, and you calculate 38%, but some deals is more, some deals is less. Okay. Currently, the success for crowdfunding platform is being communicated in funds raised for businesses. That time may coming to an end. One success will be measured in money returned to investors. What metrics are you looking at for tracking returns? Yeah, it's a great question. We've had many startups being sold and return funds to investors. And we had many startups who never sold at all. And we have many startups that went out of business and will never return to our investors. And we have some startups that actually went on the public markets as well. So how do you calculate return investment? Well, I can show you financial information from the marketplace that shows what private equity returns, and it's done by analysts over a lot of different asset classes. I would like to see Kingscrowd do this work, what you're looking for, which is tracking returns. For us to track returns, we can do that on company by company, but we don't have the information from the company such that we could know exactly what the value of the stock is. We may know what how much they sold the share price of the last sale, but we don't know what the real value of the company to give you a return on investment analysis. I think it would be misleading for us to say, okay, this company raised money at 10 million, so they're worth 10 million. No, they raised money at 10 million. They might be worth 10 million. They might be worth less. They might be worth more. But we don't really know what they're worth. And once they're sold, we know what they're worth. When they go public, we know that it's worth because it's an event. But you know what happens with the public? It goes public, let's say $20 a share, it goes to $50 a share, and then goes to $2 a share. So then what are they worth? What's your return on investment? Should we mark it at the time they went public? We always do better. But then the investors are not able to sell on the first day. They sell 2 weeks later, and now it's worth a quarter of it. That doesn't work. So I think I don't have an answer for that as to how to track it. The only thing I know is that we're telling investors that they should build a portfolio. Instead of investing in one deal, investors should have a portfolio of several companies, early stage and late stage, like private, if they're accredited. If they're not accredited, then they focus just on the crowdfunding. Okay. I love the platform, have invested in several companies, but exits have been very few. Can you give me some color on exits going forward? Well, yes. I think it's very clear that the last 2 years, exits have been hard. In 2021, that was not hard. We came out of COVID, market was frothy. That's what you need. So I think we need a frothy market. Maybe next year. So I think the answer is let's wait till next year and see how things are going. It's possible that the market gets much better for IPOs. By the way, when the market for IPOs gets better, also the market for investing in companies gets better. From the venture capitals, from the angels, from crowdfunding, everything grows. So you know what? Interest rates are pretty high. There's signs that interest rates will go down. Let's hope for the best. Let's just hope that next year is going to be even more exciting. I think, frankly, the investors who invest in private today are making an interesting bet that we're at the bottom of a market that can only go up. That no one knows. No one knows where we are at the marketplace, but I can say that we're not at the top of the market. The top of the market was 2021 without any doubt. Then 2022 started going down. It went down further in 2023, and it kind of stayed there. And we saw in 2024 starting to come back up. So that's what I know. Okay. As StartEngine Private progresses, have you seen any of these large companies show any interest in Reg A raises? That's really, we only dealt with a very small amount of companies, and frankly, they're not raising any money right now. There's not what they are. They are done, most of them, raising money. Maybe they do one more round, or what they do? They do rounds where they don't raise money for the company. They just raise money to sell shares. Why? Because investors want liquidity, and they don't mind finding new investors who want to buy the shares of the existing investors. And it actually is a good thing because it allows them to delay their public offering a little longer. So then when the markets are more receptive, there's nothing good about taking the company public when the markets are not receptive. I can tell you that. It's like, why? Why do that? Well, sometimes companies need to do it because they're running out of money. So go raise money. But in other cases, the investors are like, hey, we've been here 5 years. We want out. Fine. So they go raise 500 million, buy out a bunch of the investors. The new investors are fresh. Everybody's happy. Okay. Did you say earlier that you were going to do a 20-for-1 stock split for StartEngine? We did it. We completed a 1-for-20 stock split. It has been completed. It's done. It's been filed with the SEC. It's done. Okay. What are the prospects of a broadening in the definition of accredited investors, and what would it mean for your business? Well, the good news on that section is that there seems to be a very strong desire with the SEC to broaden what an accredited investor is. So, for example, recently, about maybe a year or two ago, a couple of years ago, they allowed anyone who's in the financial industry, stockbrokers, bankers, people who are in those industries, to become accredited regardless of their income and assets. And that was very well received. I think they're going to continue to improve on it. It doesn't mean that accredited investor, everybody becomes accredited, but I think they are looking at maybe when someone has experience in investing, that would count. So if you made so many investments and you have this many, whatever, hey, that could be accredited as well. So I think there will be some good ones. All right, Caleb is asking, I know StartEngine was exploring a white label service at one time. Is that still ongoing? I think what you mean by white label is to provide our plumbing, our broker-dealer, our transfer agent, our trading marketplace, all these services that we use internally for ourselves, for other people. If you look at Dalmore, I think Dalmore is a white label service company. We're not. I think we should stay in our lane right now. I think that's the best answer. What does it mean to stay in our lane? Very simple. We are a brand. Our brand offers to investors investment opportunities. Those investment opportunities are varied, and they are part of our community we've built. And we will allow them also to trade. So not only they can invest on StartEngine, but down the road, we offer some form of liquidity with the trading to the extent we can improve on it, right? That engine is what we are. If we became a white label as well, we would diversify outside of our lane. And typically, companies who go outside of the lane experience issues because they are not that good at that. I think we should get better at what we do now, our core business. I think we should get much better. I think we should get much better to offer more things to our investors and hopefully more liquidity options as well. A full service, everything in under one roof. Imagine you're an investor and you want access to private equity. You come to StartEngine, you have all the different asset classes you need. That would be fantastic.